You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
There's many different ways that you can, in this sector, that you can get a 10-bagger, and I'll go into that in a little more detail. But first, I'll say that the best time to get a 10-bagger is, and this applies to all sectors, is when you're coming out of a bear market or a major bottom, because that's when things, they move the most. And we've seen that, we saw that in 2016, and we've even, to some degree, we've seen that recently since March. I mean, that was an unpredictable crash that we had in the sector.
Thank you for tuning in to Mining Stock Education. I'm your host, Bill Powers, and I will be speaking with Jordan Roy-Byrne from thedailygold.com. If you followed the gold space and the junior gold mining stock sector, I am sure that you're already aware of Jordan and his commentary. He also offers a stock picking service in the gold stocks. If you're not familiar with that, head on over to thedailygold.com to learn more. Jordan, thanks for coming on the show again. It's been a while, so it's good to catch up with you. And it's been quite hectic and crazy, it seems like, in society and in the markets since mid-March. And I'm wondering, as you use your interpretive grid and your template for interpreting what's going on in GDX, GDXJ, and the precious metals, has your template of interpretation changed at all due to the unprecedented financial situation and quantitative easing that we find ourselves in?
Well, I think what's happened is, especially with the COVID-19, it's really accelerated the bullish case for precious metals. Fundamentally, precious metals are driven by declining real interest rates. I mean, it's always been that for decades and decades. And, prior to the pandemic, they were cutting rates and then they were kind of in pause mode for a while. And, I was thinking, okay, when they restart the cuts, that could be when the sector makes a big leap. But of course, I was not expecting there was going to be this huge sell-off and like a 50% crash in the stocks in a month, that would happen, kind of like a 2008 scenario, but only in a, just on steroids, and then happening in a much shorter span of time. So with that happening, you get the huge rate cuts, and they're providing helicopter money to people, and so all of those things are very bullish for precious metals. And just the way it played out, I mean, you had a huge sell-off and a crash first, basically, and now everything is rebounded, just with huge momentum behind it. So it really, I mean, COVID-19 really accelerated the bullish case for precious metals. And just as a side comment, I would say, I mean, even if there were no lockdowns, you were still going to have a recession and probably similar policy, because, I mean, look at what's happened in Sweden. So it's just a side comment that it's not true that everything that happened is because we had the lockdown. I mean, consumer attitudes would have changed anyway. And people would have locked themselves down to some degree, and we'd have a recession anyway, because, I mean, again, that's happening in Sweden. So, yeah, I mean, kudos to the people who saw the pandemic coming and, traded appropriately. But now it looks like, the worst of that is with respect to precious metals, and maybe the stock market is over, and it's just accelerated the bullish case for gold. Obviously we can't cut rates below zero. I mean, I guess we could if the market forces that to happen. But yeah, I think we're set up for a really good situation in precious metals, and that's also reflected in the charts.
You mentioned 2008 on steroids. So when you look back just to March, do you interpreted that as like an accelerated 2008 dynamic, where after Lehman Brothers, the gold stocks went down about halfway as the general equities fell, and then they bounced back really strong through 2011, 2012. Do you interpret that as just an accelerated case of that? And then my second part of the question is, should we expect going forward in this next leg up of the gold bull, should that be accelerated, and perhaps we won't see some of the pullbacks or consolidations being as strong and as long as you might in a different bull market?
Yeah, I mean, the difference 2008, it took longer to play out, and the recovery, even though it was really fast after 2008, I mean, it was like, I think it took roughly a year for for GDX to get back above its 2007 high, right? Probably a little more than a year, actually. And if you look at what happened this time, I mean, it happened in a span of a couple months. I mean, the rebound in the seniors like Newmont is just breathtaking how fast that happened. And then they made new highs, I mean, literally within a month or two. It's absolutely incredible. But, with respect to the path forward, it's interesting because, 2008, we had this 2.5-year cyclical bull, and, we had this incredible rebound, and then the market kept rising without these long consolidations. And it's something I need to look at more detail, but if you remove 2008 to 2011 and you look at the 2000s and then the 1960s and the 1970s, the movements in the sector where you had these, for the most part, I mean, you have these huge moves higher, and then you have like a 6 to 12 month consolidation. Like we saw a lot of that in the 2000s. And it's, I'm not quite sure if we're going to go the 2008 route where, we trend higher, but we have corrections along the way. We kind of grind higher, or if we're going to go the other route where, you basically have this huge move higher and then the market consolidates and goes sideways for 6 to 12 months. We could also get a combination of that. But I will say, I mean, the day we're speaking here, Tuesday, we're seeing a sell-off in the sector, but it looks like, especially if this sell-off holds, we could be seeing more of a correction, something we haven't really seen since the March bottom. And, I think it's a good thing. And it points us more towards the 2008 recovery scenario. And I think that's a good thing, because my fear is that we get one of these moves like we got in the early 2000s where everything just screams higher and goes vertical, and then suddenly it stops and the market consolidates and corrects for 6 to 12 months. I mean, that's great for traders, but for buy and holders, that's very difficult. So, I mean, we could be, it's hard to say just because of what's happened over the last couple of weeks. Okay, now we're going to follow the 2008 to 2011 template. It's hard to say, definitively that that's going to happen. But right now, I would kind of lean towards, it looks like that's where we're at here and now for the market. But I mean, Bill, it's possible at some point it could change where we could grind higher, but then next year or whenever, we could have a really sharp move higher and then a 6 to 12 month correction before the next leg higher. So it's possible both could happen. But I think here and now, if I had to answer one way or another, it looks like we're following more the 2008 to 2011 scenario.
In your own portfolio, how much cash do you still have left, or are you fully deployed?
I have about 15% left.
Just in case there's another sell-off or just another good opportunity you might find?
Exactly. I like to keep a small amount of cash just in case good opportunities arise. But, if this correction continues, I would like to put a little bit more of that to work.
We'll be right back after this word from our sponsor. Arcana Corporation is on the verge of bringing the world's highest grade silver mine into production. The Revenue Virginius mine in Colorado has proven improbable silver reserves grading nearly 37 ounces per ton silver, with an all-in sustaining production cost of only US $8 per ounce of silver. The mine is fully permitted with infrastructure already in place, and the company has announced they plan to commence production in 2020. Achieving successful production usually results in a significant upward share price re-rating on the Lassonde curve. Arcana trades under the ticker AUN in Toronto and AUNFF in New York. To learn more, go to arcana.com. That's AURCANA.com. Jordan, I've been getting a number of emails from investors that are newer to the precious metals mining stock sector, and some of them are choosing to play it just by buying GDXJ, the ETF. For those investors that want to protect their gains, twofold question. Number one, what should they be paying attention to the most from a technical standpoint? And number two, if you were them, how would you deal with stop losses?
As far as stop losses, I like to use like a mental stop loss of 20%. If you think about, if you have 5% of your money in one stock and it goes down 20%, that's, you're limiting, and you sell at that point, you're limiting your risk to 1% of your portfolio. Of course, it looks like we're in a clear bull market now. And so there is the risk of getting, of buying something, it goes down 25%, you get stopped out, but then that's the bottom, and then it zooms a lot higher after that. So that can happen in a bull market. But when you're buying individual stocks, you need to have some kind of risk control in place like that. You also, now selling on the way up is really, really hard, but I think the best way to handle that is you let your winners run, but you trim as a stock moves higher. So, and again, all of these rules, like, you have to use what's best for you and use your own numbers. I mean, some people, they sell half of it after a double. So, for a risky stock, that might be a smart move, but let's just say you own a junior and it's not that risky. It's a pretty good business. It goes up 100% or 150%. Maybe you sell 1/3 of it and then you let the rest run. You put that capital into something else. Maybe it goes up 200% and you decide you're going to sell half, and you do the same thing. You take that capital and put it into something else. So that, as far as selling, that's how the best investors and professionals really sell. It's hard. You're never going to pick the absolute top. Anybody who told you that they can do that is lying, because you can never do that. So you really have to have some kind of system in place where you can capture most of the gains, and when something turns lower and you're losing money, get yourself out, because you don't want to have a huge hole in your portfolio. And you just, as it goes higher, let it run. But at some point, if it's up too much, it's too big of a percentage of your portfolio, just trim it. Sell 1/3, maybe sell 1/2 if you need to. That's always the best policy. Now, I'm sorry, can you repeat I think the second question you had about, or maybe it was the first part?
For newer investors to GDXJ, what's the number one technical thing that they should be looking at?
Well, that's an excellent question. I would say price, and I don't want to go too much off on a tangent here, because I know this might bleed into another question. But when you're new and you're not an expert technical analyst, put a chart up, put the 50-day and 200-day moving average on it, and focus on price. There's all these other indicators you can use. Just ignore that. Just focus on the stock, look at the trend, how it's performing, look at the key levels. So I would say you have to focus on price. And there's a lot more layers to that answer, but I'll just leave it there. Focus on the price of the stock, moving averages, and then look at the chart. And right, I think you were talking about GDXJ. Look at various key levels. You have to look at various support and resistance points. GDXJ, where we are here and now, it's really in a good position because it's correcting and consolidating below a 7-year resistance. It's getting ready at some point to make a huge breakout. Whether that happens in 1 month or 4 months, I'm not quite sure yet. So I wouldn't. I understand the question, but I wouldn't be too concerned about sell-offs or getting yourself stopped out of the market, because I think you have to be careful. You don't want to get too cute before GDXJ breaks above this 7-year resistance, because that's a hugely significant technical event if and when it happens.
Jordan, what's the breakdown of mining stocks in your portfolio in terms of royalty companies, producers, development stories, early stage exploration plays?
I have a good mix of all of them, honestly. I think I only have one royalty company. I'm not a huge fan of the royalty companies. It depends. I like to be more aggressive, but I think for people who like to be conservative, those are great. But they have, relatively speaking, those things have moved a lot already, and you're going to make more gains in the riskier stuff from this point forward. So that's why I only own one. But I have a good mix of, producers, explorers, and developers, to be honest.
Do you like the prospect generators at all?
No.
Why not?
I don't. They don't have any gold. This is a gold and silver bull market, and it's a gold and silver bull market. And
But they're looking to find gold, right? You get the potential upside without all of the risk? No?
well, I could take that in many different directions. The prospect generators are sold as a lower risk type of company, and that's true. But it's lower risk for the company itself and the people who are involved in the company. It's not any lower risk for the retail investor. So, in mining conferences and, various interviews, you hear people who are much smarter than me talking about, the prospect generators, lower risk, this is great, et cetera. But those people, they're making money financing the companies. They finance the companies. They get warrants. So they can afford to, have, if they buy 5 of them, they can afford to have 4 of them do absolutely nothing. And one of them gets lucky and they, hit a great hole. And, the stock is a 20 bagger. You as a retail investor, you don't have the same leverage and the same potential outcomes as those people who are selling you on the prospect generators. And back to my original point, like in a gold bull market, I mean, the companies that have gold in the ground or have, high margin potential deposits, the producers that have a plan to grow production, those are the companies that are going to perform the best. Even if they don't have the best deposit, and even if it's, even if it's not that great of a deposit or it's not that great of a company, if they can run their business fairly successfully and they have the wind at their back of the gold price going up and going up, you're going to make a lot more. I mean, that to me, those are much better buys than just investing in one of these companies that is just basically hoping that they or one of their partners is going to hit a drill hole here or there and they're going to discover the mother lode. Like in most cases, it's not going to happen. So I would be really careful about the prospect generators. But Bill, here is the most important takeaway. There is one time, this is what I've been told, there is one time you want to buy a prospect generator. And that is when they decide that they have a project that looks really good, that they're going to save 100% of that project for itself, and they're going to drill that project. That is absolutely the time when you need to get serious and look into that company as a prospect generator. If they're just doing the normal thing where, we got a bunch of early stage projects and we're going to joint venture everyone out so we own 20% of 5 or 6 different things. No, that doesn't interest me. But when they say, we have 5 projects, here are 4 that we're going to joint venture out, but we have this other one that looks really, really good. This is so good that we have to drill it. This is so good that we have to abandon this great prospect generator model and drill this project. That is the time when you want to invest in it. Like, look, it's when it's so, they have a project that they feel is so good, they have to abandon their whole model and keep it to themselves and drill it. That is the time to buy a prospect generator. Every other time, ignore. That's just me.
So then how do you view these exploration companies? And as we know, these companies just burn through money. Hopefully they're creating value with the money that they just burned through, but they need millions and millions, tens of millions of dollars, if not hundreds of millions, to advance these projects. So if they get a Barrick or they get an Nico Eagle or BHP to commit $50 million to exploring this project, in exchange, the exploration company might keep 40% of the project ownership. I mean, doesn't that make sense though? If they got this big guy that's going to spend $50 million and they get to keep 40% of the upside, that seems like it might make sense to me.
Absolutely. But that's a little different because when you're talking about 50 million, that like when you're at that kind of a level, then it's clear that the project probably has some merit and it's not some dinky early stage thing. I mean, it's a big difference between, Barrick is going to spend, or a major is going to spend $1 million or $2 or $3 million over 3 years. Yes, that's great for the company. That's, even if it's a prospect generator, that's great. But there's a big difference between the major is going to spend 1 million or a couple million versus like, okay, the major is going to spend 10 million over 2 years or, 30 million over 3 or 4 years. Like that's putting real money into something, that the project really has merit versus a situation where only $1 million or $2 million is going into the ground. And in those joint venture, I mean, the major has all the power. They can drill a couple holes and say, that's it, this is garbage and we're just moving on. So your point is well taken, but you have to look at the money and exactly how much the major is willing to commit to it. Because in a lot of cases, and even in those cases, I mean, the major can still step away. But if there's that much money in the contract, then they probably think that there's some merit to the property, and they're not just going to step away.
You have launched, I believe, since we last spoke, the 10-Bagger podcast, where you interview people about how they pursue 10-baggers in the mining sector, and I would encourage listeners to subscribe to Jordan's podcast. What have you learned? This is a learning process for me, even doing this podcast. I learn a lot from my guest and my listeners. Thank you for all the emails you send me. What have you learned launching your own podcast focusing on this?
Well, thanks for the free plug. I mean, aside from getting a reservoir of potential 10-baggers that I can that I can research myself, one thing I've learned is, okay, there's many different ways that you can, in this sector, that you can get a 10-bagger, and I'll go into that in a little more detail. But first I'll say, Mike Swanson came on, and, people who've been in the sector for 20 years or so, they might know who he is. And he actually looked up the history of the term 10-bagger. And Peter Lynch, who was a real hot fund manager, and I think he retired, but he was really successful, I think, in the 80s and early 90s. And I mean, he's one of the best stock pickers and fund managers of all time. And so he actually coined the term 10-bagger. And I think Mike, I can't recall, but I think Mike was saying, and I think this is from Peter, that really the best time to get a 10-bagger is, and this applies to all sectors, is when you're coming out of a bear market or a major bottom, because that's when things, they move the most. And we've seen that, we saw that in 2016. And we've even, to some degree, we've seen that recently since March. I mean, that was an unpredictable crash that we had in the sector. But I mean, a lot of companies have doubled and tripled from those lows. I mean, so they're not quite 10-baggers yet. But, that's kind of the history behind 10-bagger. But in our sector, Bill, I would say there's many different ways you can get a 10-bagger, especially in a bull market. I mean, I think the obvious obvious way, they're the drill plays, those tiny exploration companies. They have a great hole, or they have a couple great holes. They show something that they discover something that's going to have significant value. So through drilling, stocks can 10-bag, but not just exploration plays. One way is producers, like over a 2 or 3, maybe even a 4-year period. If you get into a junior producer at a good price, and this company has production growth ahead of it, like I said, you get into it at a good time, those stocks can 10-bag. I mean, they can't be too big when you get into them to begin with. But if you get into a junior producer, it's small enough and it has enough growth ahead of it, those stocks can be 10-baggers. In addition to that, you also have the development side, where you have these companies with big deposits. Maybe they're slightly economic or a little marginal, and you get a real bull market like we're in now, and those companies can, those stocks can also 10-bag. So that's really what I've learned. I mean, I've learned the history of the term, where it came from, and also that whether you're looking at producers, developers, explorers, ground floor stuff, early stage, post discovery exploration and pre-discovery, there's numerous ways that you can find a 10-bagger. Now, which of those ways is best right now? Don't ask me that, because I don't know. I'd really have to think about it. But it probably comes down to the company and its value. That's one thing I would say. Guys like me, we love to obsess over the trend in the sector, and it's going to do this and that. But ultimately, company selection is so important. So I would urge people to focus. If you're looking for a 10-bagger, first and foremost, focus on company selection.
Jordan's website is thedailygold.com, and if you go over there, I have the homepage pulled up in front of me. You can see his new book, The Coming New Bull Market in Gold, and if you enter your email, Jordan will send you a electronic copy of that book. As always, Jordan, I appreciate your insights, and thank you for coming on today's show.
Thanks for having me, Bill. My pleasure.